Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will chat about the volatility of the equity markets this past week. Sprott U.S. Holdings CEO and President Rick Rule doesn't think President Trump will be able to accomplish much because of his unfocused approach to dealing with issues. Rule tells us what to look for when investing in junior market companies. Robert Campbell from realestatetiming.com says it could be the last hurrah in the real estate cycle. He says the worst thing you can hear from an investment advisor or realtor is, "This time it's different." We'll talk to Ross Clark right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
Happy Victoria Day long weekend, everybody. My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Pleasure to be with you, Jim.
The U.S. equity markets, quite a little bump down midweek, but did we come back towards the weekend?
We did. We came back in a very big way on Friday after having a rough couple of days in the middle of the week. All the anxieties over things going on in Washington has just been enough to put question marks in people's minds in terms of how quickly tax legislation can come through. There seems to be now a very strong feeling that it'll be into 2018 before anything conclusive happens there, and anything as far as the other legislation clearly seems to be at this point slowed down. So we got the first real hiccup that we've had in a long time. The S&P was down about 1.8%. That's the first 1% day we've had this pretty much this year, and the biggest drop since early in September. Now, we've been going through this stretch of low volatility for quite a while. So to get this spike up that we saw in the midweek is not unusual, but it would appear that the market still is fairly resilient. It came back pretty well at the end of the week, and that was with a very, very weak U.S. dollar. Pretty much all week the dollar's been giving up ground. The index had been up around 99 at the tail end of the previous week. We closed off this week at 97 or so. And on our modeling that we have, the major uptrend, if one was to just look at the normal trend lines, those have been violated when you look back to coming off the 2014 bottom. But within the pattern that we have, 96.5, just another 50 points where we are right now, is the optimum support level. I think it'll be very, very important to see how well the dollar can hold there, because it's got implications as far as all of the other items that are priced in dollars, that being oil and gold. So we'll be watching very, very closely here.
Canadian equities also up. Are they affected as much by Trump's comments as they are in the U.S.?
Well, the Trump comments and the fact now that NAFTA clearly is now in play. This is going to take a while for all of that to happen. But the Canadian market been bouncing around as much with commodities as anything. It closed off the week with just a marginal loss. But the Canadian market has been one of the weakest when you look around the globe, and it's even at this point, for all that we've got little resiliency as far as the oil complex is concerned at the tail end of the week, it's still a pretty heavy-looking market here in Canada.
Has the home capital crisis affected the banking stocks?
Well, whether it was home capital or just the questioning of the real estate market in Canada and the debt loads of Canadians, the banks have been under pressure pretty much since they peaked out in February. And our models, when we look at them, we're down to just thrashing around the 200-day moving averages in most of the 5 major Canadian banks. And on a weekly chart, we've got what we call a sequential TD9. This is where we had 9 consecutive weeks of being on the downside. And looking back historically, this generally gives you an interim low. So I'd be looking for the major banks who are going to report earnings starting next week to get a pretty good bounce out of the levels that we saw here at the end of the week.
Oil got over the $50 a barrel mark. Is it going to continue up, or is that the $1 billion question?
That is the $1 billion question, and we had been thinking that if we stayed under 50, that it was very good odds that we were going to push down through 47 and then probably through the lows of this year. But the OPEC, or not so much OPEC, but at least the Saudis and the Russians at this point seem to have put enough of a lid on, or talk of putting the lid on production to through the end of the year. We'll see what happens when it comes to the OPEC meeting and whether the others come along and agree with them. But it's always a question of how do they react to the statements that they have come out with. So we'll be watching for production numbers as we move through the summer. For now, it's a $47 to $54 market, and we're mid-range on that.
And we've heard, too, that some American frackers can make money when it's down to $15 a barrel. That's what the Saudis used to say.
Yep. Clearly, for ones down in the Permian, there's some pretty cheap production numbers that are available for them down there. So I think, but the thing right now is that the forward curve, when you look at it in oil, is pretty flat as you move out. So there's really no ability for the frackers or those who want to hedge forward. They can't get any premiums to work with out there. And without that, then they're not going to be gearing up production as much, whereas if they've got those good premiums to work with, they can sell forward a year or 18 months and be guaranteed some good numbers. Right now, all they're getting is the same $50. So they're not going to be as aggressive as they would have been if the forward structure was more attractive for them.
Ross, have a great long weekend.
I plan on it, Jim, and I hope you do as well.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Coming up, Rick Rule, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Rick Rule. He's the president and CEO of Sprott U.S. Holdings Incorporated. He's speaking to us from California. Rick, welcome back to This Week in Money.
Pleasure to be on with you, Jim. Thank you.
And the Sprott Natural Resource Symposium will be at the Hotel Vancouver, July 25th through the 28th. For more information about the show, you can go to naturalresourcesymposium.com. How's the show shaping up?
Well, bigger and better than ever. We had the good fortune of taking it over from our friends at Agora, who had run it for 20 years, and of course took it over at a cyclical bottom. So we will go from the first year attendance under our stewardship 4 years ago of about 300 people, up to a sellout crowd of 1,000 people and 65 exhibitors. We're obviously still, thrilled with the speakers roster. We have Jim Rickards back as a headliner, who was with us last year and got outstanding reviews from the crowd. And he's joined by David Stockman, the former budget director in the Reagan years in the United States, who has a lot to say about the current political economy in the United States, particularly in the context of Trump's proposed changes. So we're looking forward to a great conference this year in a rebounding natural resource market.
And those changes might happen faster than we think. Mexico is saying that Trump will put Congress on notice for NAFTA changes next week.
Trump is doing a lot of interesting things. My own supposition, frankly, is that Trump is mostly narrative, that he's trying to pick 50 fights simultaneously. And in picking fights simultaneously, he's unlikely to win any. He, of course, in the United States has some challenges right now over his handling of the FBI director, and the sort of memos with regards to that. But what he does do is he changes the narrative on a continual basis. It's important to keep up with that. And it's important also to understand the nature of the potential changes in the American political system and the American discourse with regards to things like how do we fund health care? How do we handle entitlements? What does our defense policy look like? What is the correct level of taxation, and what are the right sources of narratives? There are many discussions that are ongoing in the United States right now that are critical to natural resource markets, and it might not be that Trump himself is instrumental in any change, but the truth is he has been instrumental in calling these conversations up for discussion. And understanding the nature of the direction of these discussions in the world's largest economy is an important thing for natural resource investors to do.
We hear the U.S. stock market could double if Trump gets his tax cuts. We also hear the stock market could collapse in the second half of 2017. What do you see ahead for the U.S. stock markets?
If you give a stockbroker or a newsletter writer use of the word could, terrible things can happen, because anything could happen, of course. My own suspicion is that a tax cut, or even the threat of a tax cut, would be very good for the U.S. economy and the stock market in the near term. The question is, how do you finance the tax cut? People seem to forget, when they're focused on the tax cut narrative, that the United States at the federal level already has on-balance sheet liabilities of $20 trillion. Remember that we had this tax cut one time before in 1980, but we didn't have a spending cut to pay for it. One wonders, given the fact that our aggregate debt relative to our gross domestic product has gone up fourfold in the period between 1980 to 2017. It's interesting to think about how much largesse we can afford to give ourselves. That's a long way of saying I have no earthly idea what the level of U.S. equities prices will be in 12 months. The good news in terms of the U.S. general equities markets is that continued low interest rates make the dividend yields on the S&P 500 look attractive, and of course lower the cost of capital to issuers. Also, despite a strong U.S. dollar, the largest industrial and commercial companies in the United States are broadly competitive internationally, with increasing market share despite a low dollar, a strong dollar, an interesting set of circumstances. And profit margins are very high. Meanwhile, the low cost of capital stimulates share buybacks. So the truth is that the free float of the biggest companies in the United States is diminishing. The bad news is that on a global basis, there doesn't seem to be much demand for anything. So top-line growth on a gross basis is difficult to come by. The big companies get it by outcompeting smaller companies. And if interest rates are to rise, then those dividend yields look comparatively less attractive at the same time that the cost of capital goes up. The truth is that the outlook is mixed. And so my crystal ball with regards to general equities prices is cracked and cloudy.
Is President Trump good for resource stocks?
I don't think President Trump is relevant to the resource market. He's useful in the sense that he provides a narrative. You can give him the bow or give him the blame for anything that you see. What's important to natural resource markets is the state of the global economy, which is not good, interest rates, which are good, and the fact that continued low commodity prices, ex-precious metals, are leading to a circumstance called supply destruction, the same sort of circumstance that you saw through the decade of the 1990s that led to the incredible bull market that we enjoyed in the early part of the 2000s. The situation that we see in front of us now is that continued low copper prices, as an example, constrict copper supply. Continued low oil prices constrict oil supply over time. And the price reactions to those often resemble a coiled spring, because when you remove productive capacity and commodity prices begin to move up, the industry doesn't have the ability to respond to the price signals with increased production because they've destroyed their capability to produce.
The U.S. and countries around the world are more and more divided. Some cases we're hearing a lot of war noise. Should gold and silver be having stronger reactions to this?
I don't think so. In the last 40 years of my experience, the geopolitical context has been part of the narrative for gold, but it hasn't been part of the reality for gold. The most dramatic correlation I can find in the gold prices is admittedly from an American point of view, but gold is priced in U.S. dollars, is that gold reacts inversely to confidence in the U.S. dollar, in particular the U.S. 10-year Treasury, and the spread between the U.S. Treasury and the TIPS, the inflation-protected security. It is interesting to note gold moving up in U.S. dollar terms at the same time that the U.S. dollar is strong. This is very rare. It's happened only twice before in my 40-year career. And in both circumstances, gold and the dollar were looked upon globally as safe havens. And in both circumstances, the dollar rolled over and gold did very well. I'm referring, of course, to 1975 and 2001, 2002. Will past be prologue? I don't know, but that's the way I'm betting, and today's price action is certainly instructive.
Does this geopolitical uncertainty add a political risk component to resource companies working around the world?
I don't think it does. I think this is political and saber-rattling. I think the political uncertainty that you need to look at with regards to resource construction is more resource nationalism and populism around the world. As an example, domestic politics in South Africa, that is the politics of theft, taking goods from the owners who developed them and redistributing them to voters, is probably of more concern to me than the geopolitical tensions between the superpowers. Resource nationalism and resource populism are always our biggest issue. It's important for your listeners to understand that political risk is a nuanced question, very seldom related to what you see on the evening news. The truth is that the most dangerous politician is the one that is closest to you. And in particular, in British Columbia, I'd pay more attention to your new legislators than I would legislators in other countries. It's the politicians closest to you that have the ability to steal from you.
And of course, in BC, we're still wondering what the final election result will be. Will we have a pro-resource government or one that thinks we should shut everything down and people just live on oatmeal, I guess?
Well, we certainly know that Christy Clark, for whatever failings she may have had, and I'm not familiar enough with BC politics to know all of those alleged failings, looked with favor on the rural economies in British Columbia and looked with favor on extractive industries. And I only hope for workers in rural BC and taxpayers in the rest of BC that the new legislature continues that process. It always amused me to see the political love, care, and attention that was paid to the motion picture industry in Vancouver, when in fact mining services and mining technology were enormously greater parts of the local economy, including the Vancouver economy. It seems, however, that the motion picture business was glamorous and therefore attractive both to the politicians and the constituencies, while mining, which was a much more important economic driver, even an urban driver in Vancouver when you think about financial services and mining process services and technologies, was ignored or even hated.
Are gold and silver in a new bull market or nearing the end of a long-term bull market?
No, my belief is that we're in the early stages, maybe inning 3 of a 9-inning game with regards to gold and silver prices. If you believe, as I believe, that the primary driver for precious metals prices is an inverse correlation with the strength of the U.S. bond market, and I think statistics show that, and if you also agree that the bond market has been in a bull market since 1982, that doesn't suggest that that bull market can't go a little while longer, but my suggestion is that the bond bull market in the U.S., with the U.S. 10-year Treasury yield going from plus 15 to 2.2 over 35 years, I believe that bond market is closer to the end than to the beginning. If that's true, then the corollary is that the gold bull market is much closer to the beginning than the end.
We'll have more with Rick Rule next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Rick Rule, the president and CEO of Sprott U.S. Holdings Incorporated. By the way, Rick will be dropping by Vancouver in July for his Natural Resources Symposium. Jim Dines recently predicted the price of silver will surpass the price of gold. Your thoughts on that?
I would have to bow to Jim Dines. He's been a much more thorough student of macro and markets than I. My experience has been that silver moves later than gold, but it moves more dramatically than gold. So it would make intuitive sense that Mr. Dines is right. But I must say, in terms of market timing, that's something that he, rather than I, focus on. So I would have to defer to Jim on that topic.
Are base metals still greatly affected by China?
I think base metals are affected by China, but I think people forget, in the context of focusing everything on China, that the largest economy in the world, the world's mouth, is still the United States. And any U.S. recovery would be important, too. The difficulty between making forecasts based on China and the United States is that the Chinese system is still fairly opaque. That is, getting a sense of inventories, getting a sense of their economic strength, getting a sense of whether the narrative associated with One Belt, One Road becomes reality is difficult. Whereas forecasting the economy in the United States, given the transparency of the U.S. economy and all of the data present, is substantially easier.
Would a weaker U.S. dollar be good or bad for the resource industry?
Well, given that commodities are priced in U.S.-based dollars, it's mixed. That is, the nominal price of resources goes up. It's important to note that in the equity sense, a strong U.S. dollar is good for producers whose costs are not denominated in U.S. dollars. As an example, if you are a copper mine in Canada and most of your input costs are based in Canadian dollars, but you sell your copper for U.S. dollars, the spread between the Canadian and the U.S. dollar has an interesting arbitrage for that producer. So I think it really depends on whose interests you're talking about with regards to the question that you asked.
What's the next hot sector in the resource industry or area?
Boy, that's a good question. My suspicion is, in terms of the equities, that the precious metals equities will surprise people this year. The smaller precious metals equities have been hurt this year, ironically as a consequence of the fact that they were so strong last year. The momentum that junior precious metals equities had in the market last year was clearly unsustainable, and they're taking a rest. That rest has been exacerbated by virtue of the fact that the ETF in the junior space has been so strong, the GDXJ, that in fact the tail, the ETF, began to wag the dog, the market as a whole. And ETF rebalancing has affected the whole market. Ironically, a junior index, the GDXJ, is so large, so popular, and so full of money that the median market cap has to move up well in excess of $2 billion. So the relatively smaller companies in that index, those which will be rebalanced down, have been extremely soft in the market and softened up an overall market. This is very attractive to me because companies that were, from my own point of view, doing good work and deserving of investment were overpriced for me 6 months ago, and they're now moving down into attractive ranges. So I suspect that the sector that will give the best overall performance in the next 6 to 12 months will be on the precious metals side. I myself am looking further out. I'm looking at materials which are decidedly out of favor today, things like agricultural minerals, which nobody wants to know about, and copper. The truth is that my discipline, the way that I've made money in the market, is not by looking at what is hot, where all of the competition and momentum is, but rather what is not, where the bargains are. Gretzky famously said he became a great hockey player by not skating to where the puck was, but skating to where the puck is going to be. And that's the sort of discipline that I think is important.
As a speculator, what traits do you look for in a junior resource company?
In a junior resource company, I look to people first. The truth is that probably 80% of junior resource listings on a global basis, including Canada, are absolutely valueless. It doesn't mean that they can't go up if they're well promoted in a good market, but it means that their downside is to zero. You have serially successful people in the Canadian equities markets, a few of them. People like Robert Friedland, Bob Quartermain, Lucas Lundin, Ross Beatty, the serially successful people. So that's what I look to first. The second thing that I look to where I can get it is Tier 1 deposits. Very, very big, very, very high quality deposits. Those are usually only available at reasonable prices during bear markets when nobody cares, or in countries where people are afraid. My own circumstance has been that I do better with very good deposits in bad countries than I do with bad deposits in good countries. So the first thing I look for is good people. The second thing I look for is Tier 1 deposits. The third thing I look for, and I think this is instructive for your viewers, is to understand that value is created in juniors by answering unanswered questions. So the third thing that you do is you ask yourself, or more properly, you ask management, what is the most important activity that you're doing that can increase the value, not the price, the value of your stock? How much money will it take? How much money do you have? Where will you get the balance? What is the probability of a yes answer? What is the probability of a no answer? And how long will it take to get a yes answer? Very often, the time frames that are required to add value are 18 months, and speculators are unwilling to wait 18 months. It's important that speculators ask themselves the probability question and align their expectations with regards to time to the time required to actually add value.
How many junior resource companies do you own at any one time?
If the question is directed to Rick Rule, then the number is about 40. If the question is directed to Sprott Inc. and all of the investment professionals at Sprott Inc., that number is 150 or 160.
Do you short resource companies that you think are poorly run?
I do from time to time short resource companies, but I have a criterion beyond their being poorly run and overpriced. I require in my own mind that I regard the company or the company's promotion as being fraudulent.
Do you think the art of stock promotion is changing with the times?
I do think the art of stock promotion is changing with the time. The basics, of course, are always the same. But the market is changing in the sense that the financing market is becoming more institutionally driven, and in the retail market, influence is disintermediating from the brokers to social media and to commentators. So it's important that successful junior resource promoters, people who are going to be successful in lowering their cost of capital, keep in touch with new messaging. Build retail shareholder constituencies which are useful in bear markets and useful for liquidity while maintaining the access to capital with big institutional investors. Mercifully, particularly in Vancouver, there's a new generation of promoters, typified by Marin Katusa, Amir Adnani, people that understand very well the balance between institutional capital and retail volume, people that understand how to build retail constituencies, people that understand how to access new media and understand messaging very well. I'm very impressed with this next generation of Vancouver capitalists in the context of their ability to lower their cost of capital through responsible promotion.
Is the regulatory environment improving, and where could regulators make improvements to help the junior resource market?
I wouldn't look to the regulators to help the junior resource market. I think regulators can only harm markets. I think that Canada probably has the best regulatory climate in the world for extractive industries as a consequence of the familiarity that Canadian regulators have with extractive industries. But the truth is that the regulators are consistently out of touch with the market, and the best thing that the regulators could do is take the rest of their lives off. The greatest harm that the regulators do is convincing the investing public that they're protected, which is absolutely wrong. Anything that the regulators do that increases trust in the system rather than decreases trust in the system is bad. Investors need to understand that their primary defense is their own best efforts. And the idea that they are being protected by the regulators, that the regulators are actually able to manage the system of misinformation distribution, is wrong.
OPEC and Russia say they plan to extend their freeze on production of oil. Will that actually have a real effect on the price?
Well, they seem to have been singularly unsuccessful thus far, and I would expect that track record to continue. If you have lived in Vancouver, understand that what OPEC is a rig. And if you've lived in Vancouver for any period of time and observed the attempted rigs on the Vancouver Stock Exchange, you understand that a rig can't last very long because the conspirators act against each other. The truth is that what OPEC is a public relations machine. Everybody puts out a narrative that's supportive of higher prices, and then everybody cheats on their quotas. You have Iranian crude that wants to come in back in the market. You have Libyan crude that's going to want to come back in the market. And you have very real needs in the host country. Meanwhile, the conflict between, as an example, Iran and Saudi Arabia, or Shia Islam and Sunni Islam, is such that neither wants to create a pricing umbrella for the other. And historically, there has been antipathy between both Saudi Arabia and Russia and Iran and Russia. The idea that those unlikely bedfellows will ever get together and actually be able to create a rig that works are, in my opinion, extremely low. And while they are all acting in that regard, the American producers, and to a lesser extent the Canadian producers, are doing such a spectacular job employing technology in the shale basins and basic-centric plays that non-OPEC production is increasing, and increasing in a market where the global economy isn't producing oil demand growth of the type that we have experienced in the past. So I don't suspect that OPEC will be successful. What will be successful over time is the market. The International Energy Agency envisions that the actual total cost of producing a barrel of oil, including amortized G&A, write-offs, historic acquisition costs, and exploration, is between 60 and 65 US dollars per barrel. The way the situation in the world works right now is we make about 100 million barrels a day of the stuff at $60 a barrel, and we sell about 100 million barrels a day of the stuff at $50 a barrel. We lose $10 a barrel, which is $1 billion a day. The industry is enormously overcapitalized, and it doesn't lose that on a cash basis because the money's already been spent. But that's unsustainable. The truth is that if the oil price doesn't rise, what happens is that the industry won't be able to make the sustaining capital investments necessary to maintain production, and we'll have a price spike 3 years from now, 4 years from now, 5 years from now. In other words, ultimately, OPEC doesn't matter, but markets always matter.
Is one of the reasons why the U.S. is successful with oil right now is that with fracking, you can almost virtually turn it on and off at will?
Well, that's overstated. The fact is that the so-called gas and oil manufacturing businesses, that is, the fracking, are extremely capital-intensive businesses. Turning it off and on at will is a bit of an overstatement. And the second thing is that fracking works in the United States and Canada particularly well in an era of low capital costs and low interest rates. If you took the U.S. 10-year Treasury from sort of circa 2.3 to 5 and saw a corresponding increase in the prime rate and a tightening in the junk bond markets, you'd see an immediate cessation of fracking in the United States and Canada. It's much more cost of capital centric than people realize. I'm not trying to say that we're going to have an interest rate rise, but if you did, I think you'd see that stop fracking dead in its tracks.
Rick, how can people find out more about Sprott?
The best way to do it is to visit our website. Come to www.sprottglobal.com and click on a link that says subscribe. By subscribing, you will receive the best ideas and information from the entire Sprott organization and also from people who we think are influential worldwide. I guarantee that your listeners will get their money's worth from that service because it's absolutely free. And frankly, as an added inducement, if your listeners would like, they can email me personally. My email address is rrule, R-R-U-L-E, @sprottglobal.com. Email me your natural resource portfolio, both names and symbols, in the text, not as an attachment, which I may or may not be able to own. And I will, on an absolutely no obligation basis, email back to you rankings, my own rankings of the stocks that are in your portfolio.
Rick, thank you so much for being on This Week in Money.
Always a pleasure. I enjoy it, and I look forward to seeing you at our Vancouver conference.
Rick Rule is the president and CEO of Sprott U.S. Holdings Incorporated. The Sprott Natural Resource Symposium will be at the Hotel Vancouver, July 25th through 28th. If you'd like more information about the conference, you can go to naturalresourcesymposium.com. Coming up, real estate expert Robert Campbell next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Robert Campbell, who publishes realestatetiming.com. And Robert, what's in the latest issue of the Timing Letter?
The most current issue, Jim, the headline for this issue is housing prices in the United States are continuing to accelerate at an increasing year-over-year pace.
And what kind of acceleration are we seeing? Are we seeing prices near the peak of 2008?
Yeah, I mean, well, no, they're not. In fact, the 32% of all the homes in the United States have exceeded that peak. Actually, it's the 2006 peak for the U.S. Housing market cycle. And so that means that 68% are still below it. Nevertheless, what I find surprising, and, you know, I let the market tell me what it's doing. I don't try to impose my own theories on it. The fact that this late in the cycle, that it's accelerating to the upside again. So you and I were speaking before that some people are thinking that housing could do a melt up as opposed to before it does a melt down, which of course means that, you know, this stuff's going to start, you know, appreciating at a very rapid rate before the next peak is reached. That's entirely possible. But that's at this late in the cycle, that's what we're in the process of experiencing right now. That late cycle desperation to buy, you know, by people that are motivated by, you know, by greed and the fact that mortgage rates are rising, you know, to get in before they're priced out completely. Remember that saying back in 2006, buy now or you'll be priced out forever?
Exactly. And then you had the big housing crash in the U.S.
That's right. It's that same mentality. The same mentality that, you know, and it's fascinating that, you know, everybody wants an asset when it's expensive, but nobody wants it when it's cheap. And it's ingrained in human nature. And that's the way we roll. And so really, you know, to be really a superior investor and not get your head handed to you, you know, time and time again, you got to do exactly what your gut is telling you not to do. When you're scared to death, you should be buying, you know, and when you think that everything, you know, couldn't be better, that's the time you got to start, you know, seeking out the door to the exit.
Well, you see the massive lineups. Now, the Vancouver, at least attached housing market has cooled quite a bit. Prices have come down a little bit, but because people were so used to high prices here, even though the prices have come down, they're still looking at spending the same amount of money. So they're buying better houses instead of these tear down shacks on expensive property.
Right.
So the prices haven't really come down. You're just getting a lot more better house.
Yeah, and for the just as you described, that's one of the reasons that, you know, a lot of people like to use the measuring tool of price per square foot, and I don't, because oftentimes it can be really misleading. So in other words, and for the exact reasons you say, in Vancouver you could have a home sell for $1 million that's been totally pimped out, and so, you know, it's you know, and it sells for a certain amount per square foot. You know, a year ago, a home sold for $1 million. It was a fixer-upper. And we're talking about the same price per square foot, whereas people, you know, selling price per square foot. And people would look at that and they say, oh, housing prices haven't come down at all. And which is, of course, an incorrect answer. Of course they have.
In Vancouver now, they say while detached homes are down, the sale of condos continues to be hot, and the prices haven't really come down that much in that area. But like everything, you reach a point of saturation where you just can't find anybody to buy at that rate or at those prices.
That's the nature of cycles, my friend. You know, finally, markets reach a peak when there's no more. When the greater fools gets exhausted, and it's the same thing that happens at market bottom. So that's the fascinating aspect of this. And while we're talking about this, you know, I think all our listeners should be aware that the behavioral economics is a very, very important subject to understand, because we're all subject to it, whether you believe it or not. Sometimes you believe it and you go, oh my God, you know, those greedy fools buying at this price. We're all subject to those emotional urges and influences. And you've absolutely got to fight those urges to do well in the market, and which is one of the reasons that, you know, one of my favorite sayings is, you know, having goals is great, but winners use systems. And it's because you need something objective to get you in and out of markets correctly, as opposed to just listening to what your gut's telling you, because your gut's going to tell you exactly the wrong thing to do. But nevertheless, I think that there's a decent chance that this could be the the last hurrah for this market cycle, and then we experience a new magnificent spurt of price appreciation. And then at that time, you know, that could be the actual peak of the market. And interestingly, here in the United States, I was just doing a study today, it wasn't in my May timing letter, but it's going to be in my July timing letter. And I was doing some analysis of past market cycles in the United States, and each bust in the U.S. going back to 1970, there's been 4 busts. You know, one in 1970, one in 80, one in 90, and one in 2006. Each one of those busts have gotten progressively, the correction has gotten progressively greater. So that's an interesting pattern. And so, you know, I know most people never believe it because they don't want to believe it. But the next correction on a percentage basis, it could be as severe as the last correction we had here in the United States, Jim. So the last correction brought down prices, 35%, being as that the markets have become more volatile in the last 30, 40 years. The next correction, surprisingly, could exceed that number and be even worse if the pattern continues to hold. That's why it's dangerous to say this time is different, because you don't know this time is different. Avoiding bear markets, whether you're in stocks or whether you're in real estate, in my view, is the biggest long-term secret to success that an investor can ever possess.
Isn't that the greatest sign of danger when the so-called market experts say, this time it's different?
Absolutely. Those are the foremost dangerous words in investment history. This time it's different, because it's a pure rationalization. Well, for one thing, most of the people that are saying it are shills for the industry they're in, right?
Exactly.
Don't get out. Don't sell your mutual fund and get out. And the reason they say that is because if you're in a mutual fund or some other kind of fund, and even an ETF, buy and hold. Because as long as you're in that ETF, they're making some kind of management fee. Whether it's low at 0.1% or high at 1%, when you're out, they're not making anything. So that advice is very, very self-serving.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Robert Campbell, who's in San Diego. He publishes the Real Estate Timing Letter. And that timing is so important. Why do people panic and feel, it's at the peak of the market, I must buy now? What's the psychology behind that?
It's pure greed. Pure greed, Jim. It's as simple as that. And that's our nature. That's part of the passions of man will never change, especially in the markets. We're driven by fear, greed, and hope. And until you can overcome those passions and start thinking objectively as opposed to emotionally, you're going to be a below average investor. You're going to experience poor to sometimes negative investment returns. And that's part of the fascination of this whole business. People don't realize what a big part human nature plays in in sabotaging you in the market. And so you've got to find some way to overcome that. And I know I've already mentioned it once in this talk, but that's why I believe systems are for winners. You find a system that works, and it's a trend following system. It's based on pure numbers, pure data, and you look at, and you test it over time, and you said, how's it performed? Wow, that's performed really, really well over time. So there's no reason that it shouldn't perform. You get close to those returns into the future. I mean, they may change a little. Heck, they may even get better. That's been the case with my market timing model that I've created. It's become more accurate over time, not less accurate. And so you stick with the system, and that reins in the emotions, and you do fine. And you do fine in the long run. So but it wouldn't surprise me at all that the things I'm seeing right now that, in the world in general, some of the high-end markets, even though it's not happening in the United States on a broad-scale basis yet, places like London, Vancouver, China, the price appreciation is slowing down in some of those major markets. And in fact, even London year over year, I believe London has the most expensive real estate in the world. I think prices are down 6.4% year over year. And interestingly, you know what they did in London? I think it was April this year on homes for let, which means rental properties. In order to increase the tax revenues coming in, if you have a rental property, I believe you can no longer, this is for London now, and maybe England, you can no longer deduct mortgage expenses from your net income. So that just really, undermined took away one of the big advantages of owning real estate. I believe that's being challenged, but sales since that bill became law, sales are down huge, like 20 or 30% in London of rental properties right now. So anybody that thinks that the tax laws can change too, and not only from market forces, but tax laws change, and that can undermine real estate value. So no question about it. Everybody thinks real estate's the safest investment, and maybe it is. Compared to some other assets, the more volatile assets, but nevertheless, it's still a risky asset, and you have to manage the risk correctly if you want to survive and do well in the long run.
Well, now both BC and Ontario have put taxes on foreign buyers, hoping that'll cool down the market.
And it did.
Well, the thing is, the markets were cooling before they put in the tax. Maybe Toronto's different.
Of course.
And they're saying if you really want to cool foreign buyers, you don't put a foreign buyer tax on, you put a tax on foreign owners. Right.
But nevertheless, those kind of forces are always available to governments. And, so in other words, when you see stuff like that coming, that potential danger coming, especially when you're late in the cycle, which, some of the major cities like Vancouver, Toronto, and London, and in China and things like that, are right now. I include San Francisco and San Jose. If that same thing happened there, you've got to start looking to head for the exits, especially after the big profits you've made. If you've been invested for, if you're bought down at the bottom or close to the bottom, and San Francisco real estate, for example, that's up 100% in the last 4 or 5 years. And let's say you bought it with 20% leverage, so you multiplied that 100% times 5, you've made 500. You have a 500% return on your money in 5 years. That's 100% a year. Is the market going to give you 100% per year on your money forever? No.
Is this the time then for people to sell, hold on to the cash, and wait for prices to come down?
Absolutely. That's keeping your powder dry, Jim. And I know there's transaction costs, involved with that, selling and, selling your property and then paying the capital gains tax. But from my point of view, managing the risk correctly and having your money available when the next great buying opportunity arrives completely outweighs, those risks that I just described. Yes, in the markets is always this, buying low. That's what Warren Buffett does. He calls it buying with a margin of safety. And that's how he has made all his big money, buying low. And that's what I encourage other people to do. So sometimes that involves waiting. Sometimes you have to sell, and you may have to sit on your hands for 2 or 3 or 4 or 5, or who knows how long it's going to take the market to hit a bottom. But when that market hits a bottom, that's when you ought to be looking to deploy that capital, and that's where you'll make the high returns. Not buying late in the market cycle. That's when you lose money.
Yeah, the time to buy is not when people are lining up for days to buy a condo that won't be built for another 5 years.
Absolutely. I mean, that is what happened in Miami, the condo capital of the world, in 2005, 2006. And then what happened afterwards? Those condo prices fell 75%. So I know it's fascinating. So to show that, where the risks are and where the opportunities are. Like Warren Buffett says, he goes, I can tell you how to be massively rich, and here it is. Close the door. Buy fear and sell greed. And it's that simple. And of course, Warren Buffett claims, he's the last one to tell anybody that, market timing works or they should pursue it. But if that isn't market timing, I don't know what is.
Some people point out, Warren Buffett isn't doing very well right now, but that's because he obviously thinks this is not the time to buy.
That is correct. In fact, some people think Warren Buffett never sells. He has sold a big portion of his share in IBM, and I think he's in the process of selling the rest of it. And he only owned that stock for 5 or 6 years, Jim. So Warren Buffett does sell. Warren Buffett isn't a buy and hold forever guy, regardless of market conditions. If he senses that there's a better place for money, or that this stock has way more risk in it than potential future reward, he'll dump it. He's done that before. But normally he's more careful when he gets into assets, and he likes to buy during recessions.
Of course, that's when people don't have money, if they're not Warren Buffett.
Well, people don't have money. For one, a lot of people could have money if they would sell at the peak, and go to cash. Now they're going to have money and have the discipline and the patience to wait until those best buying opportunities reappear. In fact, that's the reason. Speaking of Warren Buffett is the greatest market timer in the world. Greatest market time in the world, even though he says he doesn't know how to time the market. But the reason, and he tells everybody else, just buy an index fund. Buy an index fund and hold it forever. And the reason he tells people to do that is because he knows he has a very high IQ. He knows people don't have the discipline and the patience to do what he does. So he tells them to buy an index fund.
And index funds are the ones where you can't lose money?
Oh, no. Index funds, like you buy the S&P 500 like from Vanguard. You'll pay like a 0.1% management fee, and you just hold it forever. What Warren Buffett doesn't tell you, though, and here's the problem, that, every once in a while, like, once every, 6 years, 5 years, 7 years, 10 years, that index, the S&P 500, i.e. the market, is going to fall between 45 and 50%. And, of course, he advises you just to hang on. Do you know what percent of the people can hang on to an investment when their portfolio, when that investment is down 40 to 50%?
No, I don't.
Very few. But nobody talks about it. That's the reality of the matter. Nobody talks about it. Because of the pain of that loss gets greater and greater and greater. And finally people go, I'm out. Just get me out. I don't know. I mean, it's down 40%. Who knows how far it's going to go? When's it going to stop? When it's down 50? When it's down 60? Or how about in in 1930 after it fell 89%? Am I going to lose 90% of my wealth and watch it go down because in the long term, I know it's going to go back up? Hell, I'm 65 years old right now. How many years do you think I have left? That's what they don't talk about, Jim. And that's why avoiding bear markets, managing risk correctly, timing markets correctly is by far the safest way to invest.
Well, Bob, isn't the real key keeping your money when other people are losing theirs, even if it doesn't go up? It's okay sometimes to just take cash, sit on the sidelines, and watch the others play.
Yeah, you win by default. Yeah, everybody else loses 50% of their money or all of their money, and you're sitting, and all of a sudden you're sitting, in the catbird seat with cash. That's always the way it works. Sometimes, and during down markets, during falling markets, and I learned this from my dear friend Richard Russell, who died a couple of years ago at 91 years old. He said that if you can just hold your own during down markets, during bear markets, you are 80% ahead of everybody else, because everybody else is losing their shirt. It's hard to make money in down markets, Jim. It really is. So you just hang on and you go to an asset that will best protect your wealth, whether it's cash or whether it's gold or, maybe it's bonds. But you have to have the skill set to be able to take that money out of a falling investment and putting it into an asset class that tends to be, counter-cyclical to the asset class you just got out of. Now, I'm talking about advanced stuff, but to a large degree for most people. But nevertheless, that's the correct way to invest. And that's why all the smart guys invest. Some of the best investors, and I'm talking about guys specifically referring to one of my favorites, like Stan Druckenmiller. Stan Druckenmiller. Do you know who he is?
Well, tell us.
He managed a hedge fund for 25 years, and his average rate of return for those 25 years was over 30% a year, and he never had a negative year. In other words, that guy is so smart, and he's a very active investor, not a passive investor, staying ahead of the curve to generate those kind of returns. He started from zero. He had no money, but he had a sense for making money, how to make money, and he developed a hedge fund that did extremely well. And after he made something like $4 or $5 billion from fees, he shut the fund down because he says, "I have enough money, and he was like 55 years old. I don't need any more billions, and I'm just going to manage my own money and live my life the way I want to live it, without anybody looking over my shoulder." That's the kind of guys I admire. But he was an active investor, Jim, not a passive investor. He would never tell you to buy an index fund and hold it forever, like Warren Buffett's telling you to. You're not going to make average 30% a year for 25 years using that strategy. So I know the guy's smarter than most people, of course, but isn't it a magnificent challenge to at least try to, move in the direction that guys like that are doing? We've only got so many years on this planet anyway. Why not try to be the best you can possibly be during those years?
Most people think, well, that works well for billionaires. I don't have those kind of assets. What can the average person do?
That's not true. That's absolutely not true. And you may be even baiting me with that question, that I learned when I was a little kid, that if you can't manage $10,000 correctly and profitably over a long period of time, what the hell makes you think you're going to be able to manage large quantities of money? It's exactly the same principles. Druckenmiller started with nothing. He didn't start with $4 billion. He ended up with $4 billion. He started with zero and a brain in his head. So I know these guys are exceptional, but why not? I think everybody should strive to be as good as they can possibly be. And you have to think about it. You have to be thinking about this stuff all the time, studying, researching, learning, not only from your mistakes, but for your successes, and you just get better and better and better, and pretty soon you can really be called, a successful investor. And most people can't call themselves successful investors.
Are people too wrapped up in their everyday lives not to pay attention to what their money's doing?
Yeah, that's a great point. Probably that's the case. They're working their asses off just to keep their head above water and pay all the debt on their house, on their car that's completely financed, their credit card, their kids' education, all those kind of things. The last thing that they can even think about is like becoming a more intelligent investor. So I know that there's limitations to that, but there are good people to follow. There are good advisors. And in fact, I don't mean to pat myself on the back, but as far as, timing real estate markets, I don't know of anybody that has a better track record than myself. And I find it very, very satisfying that, I get phone calls and emails from people, and sometimes at my seminars I meet them personally, and people thank me. They go, Mr. Campbell, I've never mentioned this to you, but you saved my ass, or you don't know how much money you made me during, getting out of the last real estate bubble. And that's what it's all about, helping people. It's really, really satisfying, to be able to do that, It's the sign, I believe that if a man should be good at what he does. I mean, isn't that what we all aspire to, Jim, to be as men, as the warriors, as the providers, to be good at what we do? And every once in a while, somebody says you're good at what you do. And that makes all the difference in the world. It's just like me taking care of my health. Health has been my number one investment since I've been a little kid. And now that I'm 70, it's still one of my investments. And this girl at the gym asked me a couple of weeks ago, she goes, Mr. Campbell, why do you work out so hard? And I said, because every once in a while, some, cute-looking babe looks at me that's 30 or 40 years younger than me, looks at me and says, you have a nice body, Mr. Campbell. I go, that's why I do it. And she laughed and she goes, that's a good reason. Of course it's a good reason. So it's the same with being an investor. If you get good at what you do, you should work toward that. Just get better and better and better. Learn and learn and learn. And pretty soon, you can call yourself, I'm good at this. And if you're doing things correctly, you will be good at it. That's just not talk. That's, you have the ability to do that. So it's not easy, but it's not impossible.
Robert, how can people find out more about your timing letter?
They can go to my website. It's at realestatetiming.com, realestatetiming.com, just like it sounds. And there's information on there for, subscribing to my timing letter. There's a sample newsletter. You can buy my book, Timing the Real Estate Market, that shows you exactly how I do what I do as far as timing real estate markets. So if you want to be your own guru and self-reliant, buy my book and learn how to time markets on your own. That's always a good first step. Most people don't like to do the work, so they eventually subscribe to my timing letter, but everybody's different. At least I show people my methodology, and that's a good start. And, as far as, doing better in real estate, making better purchasing and selling decisions.
Robert, thank you so much for being on This Week in Money.
Thank you very much, Jim. I've enjoyed it as always.
We're speaking with Robert Campbell. He's in San Diego and writes the Real Estate Timing Letter. You can find it online at realestatetiming.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Rule, and Robert Campbell. And thank you for listening. Any questions for the show or for our guests can be sent to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.